Hi, hello, how are you? Once again, I am welcoming to all of you this video lecture. This is Dr. A B JENA, Senior Assistant Professor, PG Department of Business Management, Fakirimon University, Base of Bihar, Baleswar, Odisha. I am hopeful you will enjoy this video lecture, and this is very vital not only from the academic point of view but also from the general knowledge purposes or general knowledge point of view. So without delay, we will start our discussion. We will start our academic journey. So today's the theme of video lecture is it's a very interesting. So it's what is the difference between the partnership firm and the joint stock company. Once again, dear friends, what is the basic difference between the partnership firm and the joint stock company? And frequently you will get the questions in your exemption. So that's why it's a very vital from the exemption point of view. So I have written there are 17 bases of comparison. So I have collected many information from the books as well as from the internet. So there are 17 bases of comparison. So without delay, we will start our academic journey. What is the meaning of, on the first one basis is meaning or definitions. By taking into consideration the meaning or definitions, what is partnership firm? Partnership firm, the relations between BW, it stands for, that is between, the relationship between the person who have agreed to share the profits of a business carried out by all or any of them acting for all. So this popular definition has been given by, that is as per the Indian Partnership Act 1932, as per the section 4 of Indian Partnership Act 1932. So dear friends, you have to remember that the Indian Partnership Act is, that is 1932. As per this act, the partnership firm's activities will be controlled or will be managed and will be also taken into consideration. Then come to the joint stock company. What is this? According to the sections of Indian Companies Act 1956, according to the section 3 of Indian Companies Act, a company means CEO, it stands for company, means a company formed and registered under this act. Come to the second one basis of comparison, its act, the Partnership Act, which I have already told you, it's a Indian Partnership Act is a Indian Partnership Act is a 1932, whereas in Companies Act, Indian Companies Act is, that is it 2013. Earlier it was 1956, and the new Companies Act 2013 has replaced the old Companies Act 1956. Third one basis of comparison, it's a, that is the registration. The registration of the partnership firm, it's a not compulsory, it's a optional. Further, if a partnership firm will be registered, then the registered partnership firm will enjoy some legal rights. Whereas the registration of a company is compulsory as per the new Companies Act 2013. Next one is, that is the minimum member. What is the minimum member to start a partnership firm? So minimum member is 2 to start a partnership firm, whereas in joint stock company, so there are minimum 7 members are required to form a public company, and minimum 2 persons are required to start a private company. Then what is the basic difference between the private company and the public company, we will discuss in another video. So once again, I am repeating frequently, you will get the question in short question also in competitive examination. To start a partnership firm, minimum 2 persons are required or are must, whereas for the to form a public company, minimum 7 persons, whereas to start a private company, minimum 2 persons. Okay, next one is, that is the maximum member. We have already discussed the minimum member for the partnership firm as well as the public company and also for private company. So maximum member for partnership firm is 10 in the case of a banking business. So BIS it stands for business, but in the case of a general business, maximum member 20 in the case of partnership firm. Whereas in joint stock company, now in a new Companies Act 2013, so it's the maximum member has been enhanced from 50 in 1950 as per the Indian Companies Act 1956 maximum member was 50. Now it was enhanced to, or it has been increased to 200. So 200 is the maximum member for the private company. For the public company, it's the unlimited. It's very vital. Maximum member for the private company is 200, whereas for the public company, maximum member is unlimited. Even one share, one member can be. Next, that is the legal status. It's also very vital. A partnership firm, PF it stands for, that is the partnership firm has no separate legal entity apart from its member, because that is the properties of business partnership firm as well as the properties or the assets of the partner will be treated as one. So legal status, whereas in a just a company has the separate legal entity as per the new Companies Act 2013. Then next one, it's that is the liability. It's also very vital, and the liability of all the partners are unlimited, whereas in the case of loss, the contribution or the capital investment by the partner as well as his or her personal property will be treated as one, or will be brought forward to the partnership firm and will repay the loans and advances to the creditors or the suppliers of the money. Then in the case of a joint stock company, all the partners' liability is limited up to the holding of the shares. Once again I am repeating, the liability of the partnership firm is unlimited, whereas the liability of the joint stock company is limited. Yes. Next one is that is capital. So far as that is the capital investment. So we will find, or the partnership firm is having with the less capital employed or less capital, because there is the limited members. So maximum is 20 in the case of general business. In the case of banking business, it's 10. So that's why that is the capital employment or capital investment is less as compared to the joint stock company. In the case of a joint stock company, so there will be the more capital, because in the private company there are 200 members or 200 shareholders. In the case of public company, unlimited shareholders. So that's why we will find, or there will be the more capital in the case of a joint stock company. So next one is that is the scope. So that is the primary objectives of the business is not to maximize or earn the profit, but also that is the growth, development, modernization, expansion. So the scope of the partnership firm is less due to its limited capital, unlimited liability, as well as also the limited members. So that is the the main reason or main obstacles for the growth and development of the partnership firm. Whereas in the case of a joint stock company, so there will be, or the scope of the company is more with regard to the growth and development, and there so more capital, more market opportunities, and the managers and they are the skilled, experienced. The managers are there, so the managers, so they are managing the activities of the joint stock company. Normally the companies are being managed by the elected members of the shareholders, so they are known as that is the board of directors, BOD. In another, it's a board of directors, the elected members of the shareholders, BOD, board of directors, so they are managing the business. That's why the scope of the company is more with regard to the growth and the development. Next one is that is the transfer of shares. So in partnership firm, shares cannot be transferable easily, whereas in the case of the partner will take the consent from the other partners. Then after getting the consent from the other partners, then a partner may transfer his or her share. In the case of a joint stock company, the shares can be easily transferable or it can be easily sold. Next one, basis of comparison is the participation into management. In partnership firm, all the partners have the equal rights to participate into the management process of the partnership firm. Whereas in the case of a joint stock company, which I have already discussed, the elected members of shareholders. Who are the elected members of the shareholders? So normally they are the board of directors. So they will manage the business activities of the company. So that's why, okay, so the company, it's having with it, that is towards the growth and the development as compared to the partnership firm. Next one is that is the statutory obligation. It's from the legal point of view, from the act point of view, in partnership firm, a partnership firm is not under the statutory obligations for the compliance of any rules and regulations. If a partnership firm is not registered, if a partnership firm is registered, so definitely, so there will be some, that is the legal binding, that is the rules and the regulations. If the partnership firm is not registered, so there will be no or the less statutory obligations, whereas in a company must maintain the prescribed books and the prescribed audit procedures, okay, periodical audits. So as per the Companies Act 2013, the books of accounts, so this must be audited as per the Companies Act. Next one, it's that is the continuity or the certainty. The partnership firm can be dissolved. Dissolve means that is the close down of the business. Dear friends, dissolve means what is the dissolve? It's that is the close down of the business. A partnership firm can be dissolved on the death or insolvency of a partner. If a partner, the death or insolvency of a partner will influence or will affect the partnership firm for its continuity. And the insolvency, what is the meaning of insolvency? Insolvency means it is a position where a person cannot pay its loans and advances to creditor or the supplier of the money. Where in the case of a joint stock company, a continuity of a company is not affected by the death or insolvency of a shareholder of a shareholder. So that's why that the longevity or the life of the joint stock company is more as compared to the partnership firm. Next one is that is rights of members. The rights of members, all partner can bind the partnership firm, be a partnership firm by his act, and he is an agent. So all the partners will be treated as one agent. So they will have or they can bind the partnership firm by his act. But in the case of a joint stock company, a shareholder has no implied authority to bind the company. Next one is that is the publication of accounts. So publications of accounts, the partnership firm, the books of accounts will not be published. So it is not compulsory, it's optional. Whereas in the case of a joint stock company, the publication of a books of accounts, that is the final account, okay, what is profit, loss, assets, liabilities, etc. So these are these must be published as per the Companies Act 2013. Last but not the least, the basis of comparison, that is the winding off. Winding off means that is the close down of the business. In a partnership firm, is dissolved or will be maybe dissolved easily, and so there is no more legal formalities. So there is the less legal formalities. Whereas in a joint stock company, a company will be dissolved as per the Companies Act. Okay, dear friends, okay, a company will take its birth as per the Companies Act 2013. Similarly, the company will be dissolved as per the Companies Act 2013. Okay, so these are all about today's discussion. I hope you will learn many things from this video lecture, the difference between the partnership firm and the joint stock company. So once again I am requesting to all of you, if you like this video lecture, kindly you subscribe it, kindly you forward it, kindly you share it. So once again, thanks a million to all of you.